This is Saeed, Introduction to Finance, and this is our third live lecture. Last week we discussed about the importance of a balanced diet in a balanced life, but to have a balanced life you need to exercise too. Later I will show you my videos because I exercise every day at home. But now review your recent activities and write in the chat box how many hours you exercise. Let's say Ali is exercising 2 hours and Sarah is exercising 4 hours. Now, who is exercising more? You would say Sarah, because 4 is greater than 2. But what if Ali is exercising 2 hours per day, but Sarah is exercising 4 hours per month? You would change your answer, right? Now you would say Ali is exercising more. How you answer this question? To answer this question, we need to take both cases on the same scale. Let's say in this case, we take both of them on a week. So Ali is exercising 14 hours every week because 2 hours a day means 14 hours per week. But Sarah is exercising 1 hour per week because she was exercising 4 hours, and we noticed that she's exercising actually 4 hours per month. This means 1 hour every week. So this means Ali is exercising 14 times more than Sarah. To compare two different cases, we need to take them on the same scale. And this is the same issue we have with companies, because companies have different sizes. So we need to take them on the same scale to be able to compare them. And this is our today's topic. Today I want to show you how to compare different companies or the same company at different points of time, because they may have different sizes. So we will discuss common size financial statements and ratio analysis. Stay tuned. First, I want to show you my videos because I told you I exercise as well. Later, I want to show you the first video for today's topic. Inhale and exhale. Twist. Twist as much as you can. Bend as much as you can. hear me? Functioning. Yeah. Okay. Good evening. Let's go to yeah. Okay. So later, post the photo videos when you exercise and tag me. I want to see how you exercise every day. Oh, you can go now. Can you hear me now? Can you hear me? Not clear, huh? Hmm. So we have an issue here. Can you hear me? Is it clear, my voice? Okay. So it's clear, right? So my voice now is clear. Can you hear me? Can you hear me? Can you hear me? Can you hear me? Okay. So, yeah, I just said that when you exercise, take a picture, record a video, and tag me in your IG. I want to see what you do every day. And I want to see how flexible you are. So, um, you don't exercise? Okay, no worries. Okay. Um, so today is the third lecture, and this is our last topic on using financial statements. I'm not really a big fan of financial statements because I don't like accounting. I'm not sure what do you think, but I'm not a big fan of accounting. I like finance, I like math, I like statistics, but I don't like accounting at all. Do you like accounting? Anyway, so today is the last topic that we will use companies' financial statements, right? But today's topic is very important. Why it is important? Because it's related to your assignment. So for your assignment, thank you, Abdul Hamid. So, because for your assignment, you are supposed to, you are required to choose a company based on your name. So it's good to have a look at your assignment, the guidelines. So make sure you choose a company that its name is the first, I mean, yeah, if I'm not mistaken, your name or family name, yeah, both of them. So it's matched with your name and family name based on the instruction provided in the assignment guideline, and it's not in financial sectors. So today I want to show you how to do the assignment. So today's topic is important because your assignment carries 35 marks of your total assessment. And yep, I have prepared a few videos about different ratio analysis that we want to use today. We want, yeah, you will need to use for your assignment. Also, today we will have an activity. So for the activity, you need to use financial statements of a company and answer some questions. So during the lecture, I will provide a link to you later, right? Later. And then you need to do some activities and submit the form. So for today's class, you need to submit a form, right? And in the form, there are a few questions you need to answer. So pay attention because you need to answer some questions. Okay. So about the financial calculator, Ali mentioned that the stock has been finished with that. So is it? Because they told me they have enough. Okay, I will check and get back to you. But okay. Another Malik said it has been restocked. Okay, so try again. Yeah, because every semester they provide a few hundreds to not only to tailors. I've heard he's
and a supplier to other universities too. Anyway, I don't know him personally. He's just the person who used to come to the campus and sell the calculator to the students. Okay, so as I said, today there are a few videos, very important because they're related to your assignment, and you are supposed to do some activities today. So you are supposed to do something. So you cannot just, stay in swimming pool or in your bed and watch my videos. You need to do something. Actively participate in this class. You need to actively participate in this class. Okay, are you ready? Yeah, you can buy from any supplier. It doesn't mean you should buy. I just wanted to help you. I provided the link. Yeah, so you can buy from whoever you want. So guys, let me check. So let's start with the first video, right? Let's start with the first video. The module information is in your portal. I don't have the module information. Actually, the lectures, I have posted a link on Times. Check the link. If it doesn't work, can you check with Student Central? Yeah, why you are copy pasting the same comment? I don't know. Okay. Yeah, the module information, the link has been posted in Times, at the top of the page, but there is a new system. It's called Curate, if I'm not mistaken. So using that system, you can have access. So you need to, I think you have access through your portal. Anyway, okay, are you ready for the first video? Let's start today's discussion. 3, 2, 1.
One of the things that you may want to do with financial statements is to use them to compare different companies. But this is not possible to, it's not possible to directly compare financial statements of different companies because they may have different sizes, right? Even if you want to compare a company in different points of time, this is also almost not possible to use directly financial statements. The reason is because, again, the size of the firm may have changed over years, right? Maybe different at different points of time. Or let's make it more difficult, how you want to compare, for example, two companies operating in two different countries with two different currencies. For example, Toyota in Japan and Produa in Malaysia. How you want to compare these two companies using their financial statements, because the size of the companies are different and also they are using different currencies to report to prepare the financial statements. So how to solve this issue, because this is one of the most common things that you may want to do in finance as an investor or as a financial manager. You may want to compare different companies, or you may want to compare a company at different points of time. But of course, if you want to compare two different companies, they should be similar. They should be similar in terms of the industry sector. Okay, so how to do this? How to use financial statements to compare two companies? To do so, you need to standardize the financial statements. Means the unit of analysis should be the same. Means they should be on the same scale, right? So one of the very common methods to do this is actually to report everything, to convert everything into percentage instead of US dollar. So we call this type of financial statements, these revised financial statements, common size statements. So for example, if it's a balance sheet, we name it common size balance sheet. If it's an income statement, we name it common size income statement. So how to standardize how to prepare a common size statements? We divide it by something. For example, for balance sheet, you may divide all items that you saw in balance sheet by total assets. So everything will be reported and will be
a percentage of total assets, right, in balance sheet. For income statement, you may divide everything by total sales, right? And you standardize, or let's say you report everything in percentage instead of US dollars. So everything in income statement will be a percentage of total sales, right? So let's have a look at standardized. So this is a standardized income statement, and as you can see, everything has been reported as a percentage of total sales. So as you can see, for example, um, for example, uh, for every $1 in sales, for every $1 in sales here, we, oops, sorry, for every $1 in sale, we have 15.7 cent net income, right? So this company can convert, can generate, can make 15.7 cents net income for $1 in sales, right? Or so now you can compare different companies, right? So maybe you can see which company is performing, is doing better, right, in terms of converting sales into net income, right? Because net income is important for the company. Or another one, something interesting here is cost of goods sold. So for $1 in sale, you have 58 cent, almost 58 cent in cost of goods sold, right? So this is important in cost control for companies. So you can compare two different companies, or we can compare the same company at two different points of time to see how efficiently they are doing, for example, cost control, right? Or what else you can see here? Another example, the interest paid for $1 in sales, you have 6 cents in interest. You have to pay 6 cents interest, right? Or for every dollar in sales, you have to pay 8 cent taxes. So another example. So for $1 in sales, this company is paying out 5.2 cents dividend, right? So this is the way we can compare to similar companies, right? So this is called common size method, right? So I showed you common size income statement. The same applies to common size balance sheet as well. So everything, as you can see here, is reported as a percentage of total assets. For example, 2.5% of the total assets is in cash. Or you can have a look at others and compare, for example, balance sheet of this company for 2018 and 2019. Okay. So this was about common size financial statements. And as I said, today's topic, for those who just joined, today's topic is about, this is the last topic that we discuss financial reports of companies and how to analyze them, how to. Why? Is it? Okay. Oh, no, no. Can you hear me now? No. Can you hear me now? Can you hear me now? Can you hear me now? Okay. I think there is something. Yeah, okay. You can hear me, right? Okay. I think the mic has problem. Maybe the battery, maybe I need to replace the battery. So this is my mic. So it's not functioning anymore. So for today, I will use my headset. Okay. Uh, anyway, I forgot what I was saying, but just for those who just, yeah, okay, good. Yeah. Okay. Just for those who joined a bit late, yeah, today we have some activities, so it's important to pay attention, and the activities start from now. So I want to show you a few videos, maybe two videos, then I will share a link with you, then you need to do some activities, right? So pay attention to the videos. The next one is about ratio analysis, right? The next one is about ratio analysis. It's just 5 minutes. Then the next video is about liquidity ratios, and we want to use the concept that I will teach to you today in the following video to apply it to do some uh, financial analysis on a company listed in stock exchange market. So be yeah, okay. So stay tuned. Um, First, I want to show you a 5 minute video just to know what we mean by ratio analysis. Then we will have an activity. So it's a hands-on session, and we want to do some analysis. Okay, I won't repeat this again because I think I already explained a million times. So let me see. The next one is ratio. So this is just 5 minutes, right? But it's important. Guys, this is about your assignment.
So another way of avoiding the problems involved in comparing companies of different sizes is to calculate financial ratios. Such ratios are ways of comparing and investigating the relationships between different pieces of financial information. We will cover some of the ratios that are the most common ones in this lecture, but there are many other ratios that you can find in different resources and different textbooks. Um, there's something you need to know about the ratios is that uh, they in different references or different resources you may find the same ratio has been computed with different formula. So you need to know when you are using the ratios, you need to know how they have been computed, right? So the same name maybe have been computed the same ratio maybe has been computed using different methods from what I will show you in this lecture. Um, so so for each ratio, there are several questions that come to mind. Number one is how is it computed, right? What's the formula to compute it and what's the logic behind it? Number two is what's the ratio trying to measure and why is that information important? Number three, what's the unit of measurement? Is it US dollar or is this times or its number of days? Next question, what might high or low value be telling us? For example, you're comparing two different companies and you're using a ratio. That ratio is higher for one company and compare with another company. So what does this mean? Is it good or bad? And how could this measure be improved? At the end, you need to provide, for example, recommendation and say how you can improve it, right? So these are the important questions that you need to answer when you are working with financial ratios. And financial ratios, they may be used for both internal and external uses. Internal uses can be, for example, for performance evaluation. You want to compare the performance of different divisions or departments in the organization, so you may use these ratios. Or for planning for the future or improving different aspects of the company, these are internal uses of financial ratios. And for the external uses, it can be useful for creditors. It can be very useful for shareholders. Many investors are interested to know these ratios and compare different companies based on these ratios. Also, other stakeholders may use these ratios, for example, suppliers, customers, government may use these ratios. And
Something that you need to know is ratios are not very helpful by themselves. They are used, they are computed to be used for comparison. So you want to compare two different companies which are similar in terms of their operation, or they are operating in the same, let's say, industry. So the companies cannot be totally different companies and then use ratios to compare them. No. So you may use them to compare two companies, which is called peer group analysis, compare with similar companies or within industries. And you may use these ratios to compare, for example, the performance of a company, the same company, at different points of time. This is called time trend analysis. So it's used to see how the firm's performance is changing over time, and it can be useful, as I said, for both internal and external uses. So, and there are 5 categories of financial ratios that we will discuss in this lecture. This is just to make it easier to understand these categories. So there are so many ratios in each of these categories, and for the purpose of this module, I am using 5 categories. For each of them, I will show you a few of the ratios. Number 1, liquidity ratio. Then financial leverage ratios, then asset management or turnover ratios, then we will discuss profitability ratios and market value ratios. This is a list of ratios that we will use in this lecture. As you can see, there are so many ratios. I will explain how you compute each of them and the logic behind them, and I will try to answer those questions that I asked in the beginning about ratios. So as you can see here, I have grouped them into 5 categories, these ratios. So we will work on them one by one. Okay, so I want to show you 5 videos each for one of these categories, not in a row. So the first one is on liquidity ratio. So these are the five group of ratios that you will be using for your assignment. But as I said, there are some activities for today. Uh, is it today? Okay, it seems today some of you cannot hear me, some of you, but based on what I see here, using my, yeah, I don't know, it should be okay because I'm using my phone here too. I'm watching the same video that I'm streaming now with 2 seconds delay, so I can hear it clearly. So there shouldn't be any problem. So if you cannot hear me now, there should be problem from your side. So yeah, okay. So the first group of ratios is, and that I want to share with you, is liquidity ratios, right? But before showing the liquidity ratios, I want to show you what we want to do today. Um, Share my screen with you. Yeah, guys, I want to share my screen with you. Okay. So this is Introduction to Finance portal, but there are a few things I want to share with you. Number 1 is, let's go down. Okay, some of the things you see, they are not available because they are for teaching team, right? So it's a bit different. You see, it's a bit different from yours, but okay, what I want to show you is, you see, tutorial solutions. So if you, okay, first of all, for each topic, there will be lecture videos. So when you open these lecture videos, you can see the lecture, the live lecture, the live finance show. This is a 2 hours lecture we have every week. Then the videos that I have used and some extra videos, right? So these are the videos you need. I mean, they have been prepared for each topic. This is for topic 1, right? is for lecture. Then there is, for some of the topics, I have posted my last lecture on the campus. So this is for 2019 lecture. So it was captured using Rewind. And then the slides, tutorial questions, and for topic 1, I have posted tutorial solutions because we finished tutorial topic 1. I mean, we worked on the tutorial questions already. You see something very interesting. The teaching team has prepared a video for each of the questions of the tutorial questions. So this is tutorial 1, question 1.1, question 1.5, 1.6, 1.7. So these are exactly all tutorial questions that you find in tutorial notes. So there is a video for the solutions of each of them, right? But you can find only for topic 1 because we are so far we have only discussed topic 1. So then for today's topic, where is it? This was topic 1, then topic 2, then topic 3. Okay, for topic 3, I will, this is, you see, there is something here, ratio analysis, right? Ratio analysis. So later, this is now hidden. So later, I will release this, right? This will be released later after the next video. So the next video is on ratio analysis. It's around 10 minutes. Yeah, 10 to 12, 13, around 12, 13 minutes. Then I will release this. So this is a Google form link, right? I can show it to you now if you want. So now it's hidden. So now you don't have access to it. Then you need to write your full name, your student ID, email address, your phone number, and here you can see 2 links have been provided, right? Use the following links to get Alibaba balance sheet and income statement. Keep them open as we will use them during the lecture. We will use the data for March 2020. So for today's lecture, we want to do this activity. So you need to open the links, and here is the financial reports on Yahoo Finance of Alibaba, right? And you can see here you have access to income statement. So if I click, I get income statement or balance sheet or cash flow. We don't need cash flow for today's topic, so only income statement and balance sheet, right? So we just use these two, and when you click, you can see the subsections, right? The items under each of these groups. So when you open assets, it's current assets and fixed assets, right? Then you open current assets, it's cash and others, inventory, net receivable, other current assets, and so on. So the same here. When you open, you see total assets is liabilities or debt and stockholders equity. Then when you open is current assets, current liabilities, non-current liabilities. When you open again, there are different sub headings. So you need so for liquidity ratios, we want to compare the performance of different companies, or we want to monitor the performance of a company over years or across different periods, right? So there are some formulas. So we need to have this information to compute those ratios, right? So what you need to do is later I will release the link, then you will be directed here, and as you can see, here, okay, full name. My name is Saeed. And email address, okay, oh no, phone number. Okay, here I don't want to, so I just write something, but you need to write your phone number and then next, right? So when you fill out, you will get the form. So here you can see I asked you to compute the liquidity ratios, right? You see liquidity using the March 2020. So March 20, so this column, we will be using this column, this column. And here when you go here, March column, right? March column 3 2020, 30 3 2020. So we use this column, and for balance sheet again March column, to calculate, right, to calculate the ratios, right? So later I will really, so you need to watch the first video to be able to answer these questions, right? And then when you click next, the next group of ratios, we, as I mentioned, for this subject, I may discuss 5 different group of ratios, right? Okay. Let me have a look at the chat box to see if there's anything important. Yeah, to answer your questions, Qazi Tacit, he asked me, will you enable the form after the following 10 minutes? Yeah, immediately after the next video, which is 10-12 minutes, I will release the form. I will inform you, then I will release the form. I will tell you guys the link is there, go and click there. Then you will be directed to the form and you start today's activity. So I will show you the next video, then you answer the next question. So when you get the link, no need to answer all questions. You need to just answer the liquidity ratios. Then I will show you the next group of ratios. You answer the next page. So one by one. We don't finish all immediately and submit. No, one by one. So till the end of the class, we will complete the form, right? Okay, about the attendance. Sometimes, for example, previous semester, I use this. Some of the students had some issues, so I use this to see whether students were active. Because later, they may ask me to report about your attendance in terms of whether you were actively participating in this class or not. So these, of course, can be used to monitor your attendance. Attendance doesn't mean that you are just watching this video. I want to know whether you are actively following the lecture or not. Yeah, about the midterm exam, later I will give you more info. And Rod Sharar, I will give you more info later, no worries. And any other thing? Samrin Tanvir. Later, after the next video, I will release the link. I will let you know. Don't worry about, just stay tuned. I will let you know. And let me see. Okay. For the assignment, only one company can be taken by one student. So one company cannot be taken by 2 students in one tutorial class. So you need to check with your tutor. Also, you are not allowed to choose financial and banking companies from financial companies and banks, right? What I'm saying. Okay. Okay, are you ready, guys? I want to show you the next video, and for the next video, as I said, you need to pay attention because we want to do some activities. So 3, 2, 3, 2, 1. Let me check. Yep, liquidity ratios.
Liquidity ratios provide information about the firm's liquidity. So the primary concern is the firm's ability to pay its bills over the short run without any stress. As we already discussed, when we talk about short term, we mean anything less than 1 year. So the focus of liquidity ratios is on current assets and current liabilities that we already discussed in previous topics. So liquidity ratios are interesting to short-term creditors because they want to know whether you are able to pay your short-term liabilities or not. For example, as a financial manager, you may constantly work with banks and other short-term lenders, and one of the
one of the aspects, one of the things that you need to look at it to maybe report to your short-term creditors is liquidity ratios. So one of the advantages of using current assets and current liabilities is that their book values and market values are not usually much different. So we expect them to be similar. However, like any other thing near to cash, their value may change quickly. So the value of the current asset and current liability today may be totally different from a point in the future. So there are a few ratios that I want to discuss under liquidity ratios category. So this is what I have provided here is the balance sheet of the company that you are working on it, and I will use the same example. I will be using the same balance sheet, and same income statement in all examples for computing all ratios that we will discuss in this lecture. So now we are working on liquidity ratio. So we focus only on current assets, as you can see here, current assets and current liabilities. So means any asset with a life of less than 1 year and any debt, any liability that should be paid off in less than 1 year. So uh, uh, liquidity ratios, for liquidity ratios, we will compute current ratios, current ratio, quick ratio, and cash ratio. So these are the three most common ratios under liquidity ratio that we want to discuss. So the question for liquidity ratios is, we use liquidity ratios to answer this question. Are there enough liquid assets to pay current obligations or not? The most well-known and most commonly used current liquidity ratio is current ratio, which is computed by dividing current asset by current liability. So you remember that we had a formula to compute net working capital, which was current assets minus current liability, right? But here we want to divide current assets by current liability, so it's very similar, right? For a healthy firm, we discussed that net working capital is expected to be positive, right? Means we expect current asset should be greater than current liability. This means that this firm is able to pay its current liability, means those obligations that their life is less than their maturity is less than 1 year should be less than the current assets that we have in the company, right? So for net working capital, we already discussed that we expect a positive. You remember net working capital, current assets minus current liability. It was for previous topic. We expect a positive to be positive for healthy firms. So current ratio, which is current asset divided by current liability, we expect to be greater than 1. So for most cases, for most companies, we expect a current ratio of greater than 1. This means the company can cover its current liabilities using its current assets, right? Because current assets and liabilities are converted to cash over the following 12 months, the current ratio is a measure of short-term liquidity, right? So what's the unit analysis of current ratio? The unit of measurement is either dollars or times. So in this example, current assets, as you can see here, okay, let's use the data for 2019. So current asset has been reported here. Where is current asset? Here, current asset, the total is $708, but all have been reported in $1 million, right? So this is $708 million. So 708 divided by, as you can see, divided by current liability. What is the current liability? The total value is for 2019 is $540 million. So 708 divided by 540 will give you 1.31 times or dollar. This means that the company has $1.31 in current assets for every $1 in current liabilities. Or we could say that the company has its current liabilities covered 1.31 times over. So a creditor, and more specifically a short-term creditor, such as, for example, supplier, prefers higher current ratio. They expect the company, they prefer companies to have higher current ratios because this means less stress for the firm to pay its suppliers, right? However, to the firm, although we say we prefer higher current ratio because this means more liquidity, but more liquidity means may show that the company is not efficient in using the cash and other short-term assets because when you have cash you can't there's no earning for keeping cash, right? So too much cash is not really good, right? It's better to use the cash, right? It's better to use the cash to make more money, right? So if you put your cash under your mattress, there is no benefit for it. This is the logic behind it. So although for companies we also prefer higher current ratios, but we need to be careful because this may mean that the company is not efficient in using cash and its short-term assets. So usually we would expect to see a current ratio of at least 1 as we discussed because we expect the company to be able to cover its current liabilities using its current assets. So the current ratio, like any other ratio, is affected by different types of transactions. Let me give you an example. For example, suppose that a firm borrows over the long term to raise money. For example, a company issues 10 years bond. It means they borrow money for 10 years, right? It's a loan, a 10-year loan, right? This means they will have cash because they borrowed 10-year loan. They used they got a 10-year loan they borrowed for the long term. So now they have cash, right? So what happened? So the short-term effect would be an increase in cash from issuing long-term debt. In this case, as current liability has not changed, so the current ratio may increase, right? So this is the way, so this is why I'm giving you this example. This means that you need to use other ratios as well. You need to look at other figures as well to be able to interpret, to analyze a company, right? So a company may have a higher current ratio just because they recently got a long-term bond, right? So their current liability has not changed, the current debt has not changed, but the current asset, because of the amount of cash they injected in the company, because they borrowed money for long term, may have changed. So why I use this example? Be careful. You cannot just blindly say, okay, higher current ratio, so this means it's a good company or not, right? So you need to look at other aspects as well. So the second ratio we want to discuss is quick ratio. Why do we need quick ratio? Um, the logic behind using quick ratio is inventory is usually the least liquid current asset, right? And some of the inventory may later be damaged, spoiled, or even lost. Also, large inventories are usually a sign of short-term trouble. These may show that the firm may have overestimated sales or as a result, they may have overproduced, right? In this case, the firm may have a large portion of its liquidity in inventory, which is considered as a slow-moving current asset, right? It's the least liquid asset. So a company that because of some mismanagement, they have overestimated the sales, so they have overproduced their products. Now they have a large inventory. What happened? If there is a large inventory, if you look at the current ratio formula, it's current asset divided by current liability. So inventory is part of the current asset. So because they have a huge inventory, so the current asset will be big, and current asset divided by current liability will be maybe high, right? So you may interpret that this company is very liquid, but actually most of its assets, current assets, are inventory, and inventory, as I said, is the least liquid one, right? It's the least liquid one. It may be damaged, spoiled, or lost.
So to have a better understanding of the liquidity of the firm, we can use quick ratio. For quick ratio, we exclude inventory from the formula, from the current ratio formula. So it's current asset minus inventory divided by current liability. It means we put aside inventory, and then whatever current asset we have, we divide it by current liability to see whether we are, to what extent we are able to cover our current liability using our current assets excluding inventory, because we know we can't convert inventory into cash quickly, right? So in this case, we have 0.53 times. 0.53 times. This means, you see, it's totally different. Actually, for the current ratio, you got 1.31 times. Now you got 0.53 times, right? It's totally different figure. So maybe now your interpretation has changed. Now you may ask, why do we need cash ratio? Because sometimes we want to know if quickly we want to cover the current liabilities, how successful we can do it. So we deduct everything from current assets and we only focus on cash. Cash is the most liquid one, right? So a very short-term creditor actually may be interested in these type of ratios, like cash ratios, right? So for cash ratio, we divide cash by current liability, and the amount of cash is reported here 98. So we divide 98 by 540 and we get 0.18 times. Means for $1 in current liability, we have 18 cents cash. So these three are the most common liquidity ratios that you may use. Okay. Now, now you know how to compute liquidity ratios and why we need liquidity ratios and how to compute liquidity ratios. Okay. Uh, Now is the time for activity. So for the activity, so the first group is liquidity ratios. I just showed you the video. So you do the liquidity ratios, then I will show you the next video, then you do the next page of activity. So page by page, right? So for now, we just want to do the liquidity ratio. Let me see. Okay. Now if you check your times, you see that there is a link under this topic, under topic 3. It's named liquidity ratio. So when you click on liquidity ratios, you will be directed to, okay, maybe I can share it with you. Okay. Okay, can you hear me? So now now what you need to do is you click here, ratio analysis. You see it's already on time. So you click, you will be directed here. So you need to fill out this form, your full name, your student ID, your email address, your phone number, right? All, make sure it's correct and there is no mistake. For phone number, if the phone number you are using is other countries' phone numbers, then write the country code too. Then copy paste this link into your address bar. You will be directed here. Then here you can switch between income statement or balance sheet. These two pages are those that we need today. So okay, I'm reading your messages in the chat box.
Now we go for the first one. Okay, I can do one of them, right? Compute Alibaba current ratio. I have given the formula here. So current ratio means current assets divided by current liabilities. So what I can do, what I should do, okay, where we can find this information, current assets and current liabilities? In income statement or balance sheet? Balance sheet. So current assets and liabilities. So these should be in balance sheet, right? So balance sheet. So I open this current assets. So current asset, its total is here. So this is your current assets, right? For 2020. So this is your current assets for 2020, and then divided by current liabilities. So here total liabilities, liabilities, I need current liabilities. Here is current liabilities. So total assets is liabilities plus stockholders equity. Then under liabilities, you have current liabilities. And here is, so you just divide these current assets by these current liabilities, right? Current assets divided by current liabilities. And no need to write how you computed or the formula or whatever. Just write the final answer, right? Just write the final answer here. What's the current ratio? Then here, cash divided by current liabilities. So where is cash? Cash is under current assets. We are still in balance sheet. So cash for 2020 is reported here, divided by current liabilities here, right? So, then there is one more question. If the industry current ratio is 1.5, then you need to compare Alibaba and the industry, right? The average of in the industry. Okay, now okay, let me see here. Okay, so make sure so no need to go to other pages because I haven't shown you the videos for other pages, so there's no point to submit it now. There's no point to complete all now. And be patient. Just complete the liquidity ratios. Liquidity, just complete the liquidity ratios, right? Okay, guys. Now, let me see. Okay, then when you are done, we will continue. We will go to I press the next when I'm done. Yes, you can press the next button, but just wait for the next video because the next one is very short, if I'm not mistaken. Yeah, the next one is compared with the previous one is short, right? 7 minutes. So the next one is on financial leverage ratios, right? So financial leverage ratios. So financial leverage ratios is the next video, and then you can fill out the next part. So just practice, right? So wait, I want to show you the video on financial leverage ratios, and then you can fill out the next page.
Financial leverage ratios. These ratios, they address the firm's long-run ability to meet its obligation. So how to compute? Here I have provided three different formulas. Actually, all these three, they are measuring the same thing. It's the amount of debt and the proportion of debt and equity to total assets. For example, the first one is called total debt ratio. means we want to know how much of the total assets. You remember from previous topics, the total assets in balance sheet is reported on the left side, and then on the right side you report how you finance, how much debt and equity you use to finance these assets, right? To buy these assets. So on the right side you have total liabilities and total equity, right? Now we want to know how much of these total assets is debt, borrowing, and equity, shareholders equity. Means how much you borrowed and how much uh, the owners or shareholders put in. So the formula is very simple. It's actually, as you can see here, it's total assets minus total equity divided by total assets. But total assets minus total equity is total debt, right? So it's actually total debt divided by total assets, right? So in this case, and for 2019, you can find we can find them here. For example, total assets 3,588, and total equity, it's reported here 2,591. So total assets minus total equity, and actually it's total debt again, and divided by total asset. This means that for $1 in total assets, the company has 28-cent debt. Or you would say that the company uses 28% debt, right? So both of them are the same. In other words, there is 72 cents in equity, right? Because in equity will be 1 minus 28 cents, means 72 cents equity. So I can report it like this. In this company, for $1 in asset, we have 28 cents in debt, or we have 72 cents in equity, right? Another formula is debt over equity. It's the same thing, right? It's the same thing. Instead of reporting the proportion of debt to total assets, now we have debt to equity, right? So I mean, by saying the same thing, it doesn't mean the same formula. It's the same concept. Again, we want to know how much of this debt, how much of the assets is debt, the proportion of debt and equity, right? So you will get 0.38 times. This means for $1 in equity, we have, for each $1 in equity, for every $1 in equity, we have 38 cents in debt. And then we have equity multiplier. Again, this is another form of reporting the proportion of debt and equity in the firm. So total assets divided by total equity, or 1 plus debt over equity. So it's 1.38. So these three ratios, actually, they just show the proportion of debt and equity in a firm. And you may use them for different purposes, right? But at the end, we want to know how the company financed its assets. There are two more ratios that we want to discuss in this part, which is about financial leverage ratios. One is time interest earned. The formula is earning before interest and tax divided by interest. So in the previous one, let's go back here, we used balance sheet, but for this one we are using income statement, right? So for time interest earned, we use earning before interest and taxes, which is here $691, divided by $141 interest will give you 4.9 times. So for this company, the interest bill is covered 4.9 times over, right? So this is measuring how well a company has its interest obligations covered, and it's usually called the interest coverage ratio. So why do we need cash coverage? Because what you may be interested is how much cash, how much really we have, how much cash,
real cash we have to cover the interest that we have to pay out, right? For earning before interest and taxes, as you can see in the income statement, we already deducted depreciation, right? Which is not a cash outflow, right? It's an accounting term, accountant invented it, right? So it's not a real thing. It's not a real cash outflow. So to have a better understanding of the company's ability to cover its interest, its interest paid, so what we can do is we can add the depreciation, because for in the first formula we deducted depreciation and it's not really cash outflow, so we added it back, and now we have earning before interest and taxes, or EBIT plus depreciation divided by interest. So the difference is just adding the depreciation between these formula, and now we get 6.9 times, right? So as you can see, it's higher. Why? Because we had deducted depreciation. We assume depreciation is something, a cash outflow that is paying out, right? But for cash coverage, we expect it to be higher. So earning before interest and taxes plus depreciation is usually abbreviated as EBITD, means earning before interest, taxes, and depreciation, or you can call it EBITD, EBITD, or you can call it EBITD. So it's a measure of the firm's ability to generate cash from operations, and is frequently used as a measure of cash flow available to meet financial obligations.
Okay, so I see there is an intense discussion in the chat box about this activity. So please guys, help your friends to complete the form. There are some questions in the chat box. For those who don't have access to Times, I just posted the link to the Google form in the chat box, so you may directly just click there and be forwarded to the Google form that we are using for today's activity. So let me see if there is any question. For now, I have answered all questions. So now, so far, yes, I see some of you completed all and submitted. I'm not sure why, because we haven't covered all of them. Where is it? Yeah, 6 of you. So yeah, later I will check to see, to check. Yeah, I want to see your answers. But based on what I see, yeah, there are many wrong answers. Those who have submitted, many wrong answers. Anyway, oh no, sorry. Yeah. Oh, yeah, sorry. Only 6 people have submitted. No need to submit now. No need to submit now. You need to wait. Yeah, this is the reason that these 6 people, more than, yeah, 4 of them gave wrong answers. Yep. Anyway, okay, guys, let's continue. Oh, before, okay, while you are working on your analysis, so we are applying what we learned today to analyze financial performance, figures of Alibaba company. Now, what we want to do now, while your friends are working on the Google form, what I want to do is I want to show you a secret. Okay, do you want to see a secret? I want to share a secret with you. What I want to do today is, do you want to see a secret? Do you want me to share a secret with you? Let's see, where is it? Yeah. So while your friends are working on the Google slides, no need to complete all of them, just 2 pages. We have not finished, or I have not covered everything that you need to complete the form. So just to have a break, if you want, I can share something with you I have prepared. So what I want to do is that I want to share a video for my yeah, okay, yeah. So yeah, write the chat box. Let me know whether you want to see an exclusive video. Is behind the scene of what I have prepared, what I prepared for today's class. I mean, I want to show you a video about my yoga, what I did in the beginning of the class. I want to show you another video to reveal some secrets. Okay, Yifan Gong, he said, or she said, just continue. No, just continue. Okay, because you said just continue, so I won't continue. Okay, and Wenki Yo. Okay, you too, because you said just continue. So what I do is I won't continue. I will show you another video. Okay, hold on. 3, 2, I want to reveal a secret. Bend as much as you can. Yeah, this is the way I exercise. Okay, now there are some questions in the chat box. So later post some videos of your yoga. So when you exercise or you go for jogging or you do yoga, take a picture or video and tag me. I want to see how you exercise. Okay. Okay, there are a few questions. Cost of revenue and cost of goods sold is the same. Yes, for service companies, sometimes they use this term cost of revenue instead of cost of goods sold. They say cost of revenue. And then Kazi said some next level fraud activities. Yeah, this is exactly what you do in the exam. And does Texas Instrument with this round to do okay, for Texas Instrument, if you want to round to 3 or 4 decimal points, it's very easy. There is a function, you can change it, right? So just read the the manual, the booklet attached to it. So or just Google, you can change it. And then prefer alcohol rather than your stupid spoon. Okay, anyway, okay, up to you. I don't care. Okay guys, so hope you could complete your part. Now I want to show you the next video. The next video is on the next group of financial ratios, asset management ratios, and then you will be able to answer the next slide, right? So don't just submit it. I want to check your answers later. I want to see you could correctly answer the questions or not. So let's
watch one more video.
Asset management ratios. These ratios measure the company's efficiency in using its assets. So they are called also asset utilization ratios. More specifically, how efficiently a firm uses its assets to generate sales is the aim of using these ratios. The first ratio in the asset management ratios that we want to discuss is inventory turnover. And then using inventory turnover, we will compute days sales in inventory. The formula for inventory turnover is cost of goods sold divided by inventory. Cost of goods sold can be found in income statement, and inventory can be found in current assets of the balance sheet. So for this company, 1,344 divided by inventory, $422 will give you 3.2 times. This means that the company sold the entire inventory 3.2 times. As long as we are not running out of stock, the higher ratio means that the company is more efficient in managing the inventory. So if we know that we turned our inventory over 3.2 times during the year, then we can compute how long it takes that we sell our inventory. So we divide 365 by 3.2 times inventory turnover that we computed, and we get 114 days. This means that it takes on average 114 days to sell the inventory of the company. And this may make more sense if we use the average in inventory in calculating turnover. So if you want to use the average, the average inventory in this formula, you just need to find the average, the mean of this year inventory and previous year inventory, and put it in this formula. For example, if you check the balance sheet of this company that has been provided in the slides and previous videos that I showed you, the inventory as you can see, for this year is 422, but for previous year was 393. So you just compute the mean or average of these two figures, 393 plus 422 divided by 2, and then you use this figure in this formula. So it will be 1,344 divided by the average of inventory for this year and last year, and if you compute, it's 3.3 times. Actually, it depends on the purpose of the calculation. If you are interested in how long it will take to sell your current inventory, then maybe you should use the ending figure. But if for example, your focus is on the past, then maybe it's better to use the average. So it depends what you want to do, and for the industry, maybe in most cases they are reported the ending figure. So if you want to compare the company with the industry, let's say inventory turnover or days sales in inventory, then maybe you should use the ending point. So it depends on the purpose of the ratio and what you want to do, what's your concern. There is another ratio in this group, in the group of asset management ratios, and it answers this question: how fast we can collect the sales. So the formula is called receivable turnover, and the formula is sales divided by account receivable. Sales can be found in income statement, and account receivable can be found in the balance sheet. Account receivable in the balance sheet. So 2,311 divided by 188 will give you 12.3 times. This means that we collected our outstanding credit accounts and reloaned the money 12.3 times during the year. In other words, on average, we collect our credit sales in 30 days. How we got 30 days? Just 365 days divided by 12.3 times. Means every 30 days on average we can collect our credit sales, right? There is another ratio. It's called payable turnover. So the formula is cost of goods sold divided by account payable. So where can you find cost of goods sold? Yes, in the income statement, cost of goods sold, and then account payable is in the current liability part of the balance sheet. So account payable is here, 344. And if you divide cost of goods sold by account payable, you get 3.9 times. And similar to the previous cases, you can divide 365 by payable turnover and you will get 94 days. This means it takes 94 days on average to pay the bills. Actually, payable turnover and days costing payable, they measure how long it takes to pay the bills. So on average, it takes 94 days to pay your bills, right? And there is another ratio in, again, the asset management ratios. And this is measuring the generated sales for every dollar in assets. And this is called total asset turnover. And you divide sales by total assets, means for, in this case, sales, of course, you can find it in income statement. Total assets, you can find it in balance sheet. So you get 0.64 times. This means for $1 in assets, your company can generate 64 cents in sales. And now we can compute capital intensity ratio. We just divide 1 by total asset turnover, and we get 1.56. So what we did is we just flip this over, right? We flip this 0.64 over and we get 1.56. So it takes $1.56 in assets to create $1 in sales, right? So to create $1 in sales, we need $1.56 in assets. It might seem that a high total asset turnover ratio is always a good sign for a company, but it is not necessarily true. Consider a company with all assets. The assets would be almost fully depreciated and might be very outdated. In this case, the book value of assets is very low, contributing to a higher asset turnover, right? Because we divide by total assets, and the total assets already has been depreciated. So you get high total asset turnover. Also, the high turnover might also mean that the company will need to make major capital outlays in the near future. A low asset turnover might seem bad, but it could indicate the opposite. The company could have just purchased a lot of new equipment, which implies that the book value of assets is high, right? Yeah, because the company just purchased some assets, so the book value of the assets reported in financial statements is high. So this means that the total asset turnover will be low. These new assets could be, however, more productive and more efficient in the operation of the firm. So maybe it will help the company to beat the competitors, but what you get from the financial statements and using total asset turnover is another story. So you should be very careful when you're using these ratios.
Okay. So I was reading the comments in the chat box, I'm happy that you are working on the questions. This is more effective than just sitting there and watching my videos, right? Okay, clear. Okay, very good. Okay, now I know this is the time of this class is 6 to 8 p.m. and many of you, are hungry. But what can I do? I mean, this was not my choice. Who likes to sit in a class? So, but we need to accept this. We can't do anything. This was not my choice. No one asked me what time I want to have class. Yep. So maybe you can prepare some food or snack when you are in class. Maybe you can eat and also watch the lecture, right? Yep. Unfortunately, I can't do anything about the timing of this class. But anyway, at least I'm doing something that it's keep you engaged, right? So it could be one of, I mean, it's also easier for me to just log into my Zoom just 5 minutes before the class and start repeating the same thing that I have done during the past, years. But I spend a lot of time on preparing the material and all these things that you see, including the videos. Just one of you asked me why. Let me see the comment. Yep, one of you asked me that. Oh, one of you asked me. Oh yeah, two of you asked me about the timing. Yeah, it's not my choice. And one of you said, yeah, less pre-recorded videos. But I believe that the lecture, because I want to deliver the high quality lecture. So the topics will be, because the topic doesn't matter if I'm telling you now or I'm using the video that have been recorded in a studio with a high quality, right? So later you will see I spend a lot of time for preparing the videos for from next week onwards, right? For these 3 lectures, I use studio I had prepared at home. For the future lectures, there is special studio I use for record. Why? Because you see, for example, today the mic was not good, right? So if I want to teach you an important topic with a mic like this with problems, then it impact your learning, right? So for the lecture, for some parts, I have to use those high quality videos that I prepare. And actually, I sacrifice my weekends to prepare those videos. So anyway, because of the timing, I try to use different types of videos and activities. Otherwise, the class will be very boring. Again, it's very easy for me to just log in into Zoom and sit there and blah blah blah, talk for 1 to 2 hours and then say goodbye. And I believe that everyone, because of the especially timing, everyone will sleep, right? But I'm just doing my best, right? I'm just doing my best. Let's see how it goes. Yeah. Okay, guys. So what was the last one? Okay, now the next one is just 2 minutes video. 2 minutes, and you can complete the last part of the Google form, right? So later I will check your answers. So now let's watch a 2 minute, 2.5, 2 minutes and 2 minutes of 40 seconds video about another group of financial ratios, and we will continue.
Profitability ratios. So these ratios measure how efficiently the firm uses its assets and how efficiently the firm manages its operations. Here I want to show you 3 important ratios. These ratios are very important, very useful for shareholders and investors. The first one is profit margin. It's net income divided by sales. Where you can get net income and sales, both are available in your income statement. As you can see here, for income statement, actually as you remember, as we discussed before, you start with sales and then you reach to net income. So we divide net income, and that is by sales. So 363 divided by 2311 will give you 15.7%. And for these type of ratios, of course, we prefer higher. And for this case means for $1 in sales, this company can make 15.7 cents in net income. Another one is return on assets, means how efficiently this firm can use its assets to generate net income. So we divide net income by total assets. Net income is available in income statement and total assets is available in balance sheet. And for this firm, we got $363 divided by $3,588, 10.12%. This means that for $1 in total assets, this company can generate 10.12 cents in net income. And you may be interested to know how efficiently the firm can use its shareholders' equity in generating net income. In this case, we deduct the debt from the denominator and we get net income divided by total equity. Net income is again in income statement and total equity is in balance sheet. 363 divided by 2,591 means 14.01%, means for $1 in shareholders equity, this company, for every $1 in shareholders equity, this company can generate 14.01 cent net income.
Okay, so now you should be able to answer all questions in the Google form that I have posted, I have shared with you. Let's have a look at what you have done. Face. Yep. So, yeah, so here you can see not most of you, 43 of you have given the same answer for, so around half of you for the first current ratio. So this means, I don't know, so you see just half of you. So there are so many different answers. And here again, less than half have given the same answer, others different answers. Here you see all different answers. So I need to check to see yeah, I need to check to see which answer is correct. Yeah, here it seems here is more. So it seems in some parts like this one is more consistent, right? But anyway. So you should be able to complete it after this video that I just showed you. And what I want to do now is, there is just one more video, but there is no more question about this video. It's for market book value ratios. And again, some of you asked me what is cost of revenue. Cost of revenue and cost of goods sold are just the same things. For some companies which are in the service industry, it's called cost of revenue. They use this term instead of cost of goods sold because they are not selling any tangible product, right? Yeah, you can check your answers with your friends in the chat box. Yeah, feel free to discuss the questions and answers in the chat box. And cost of goods sold. Okay, you are asking where you can find cost of goods sold in balance sheet. It's not in balance sheet, it's in income statement. Cost of goods sold is in income statement and it's named as cost of revenue, right? Yeah, you can round it up. Yeah, you can use 1, 2, 3 decimal points. Yeah, up to you. Okay, now there is just the last video and then I will take the attendance for today's class. Just make sure you submit the Google form. So far 148 have submitted, but later I will need to take the attendance using CAMS. So the last video that I want to show you, the last one I can post it on Times. Yep, it's a bit late, so I can post it on Times. Instead, what I can do is, if you want, I can take the attendance. So let me know. There is one more video, 6 minutes. So let me know whether you want to watch the last video or I post it on Times and I take the attendance. Which one do you prefer? 1, 2, 3. So just write next video or attendance. Write in the chat box next video, which is 6 minutes, or attendance. Yeah, you can post. Dinner. Sorry, today no dinner. Post on time. Okay, I will post the next video, which is 6 minutes on Times, and I will take the attendance now. Yeah. Okay, are you ready? Guys, some of you couldn't key in the code into the portal and you emailed me. You need to contact ICT and if you missed it, right? But don't worry about the first class. Any issue, please contact your tutor, and if there was any problem with the app, contact ICT. Now, I want to take the attendance, so use the Taylor's app or portal and key in the code I want to share with you. Anson Chen, thank you very much. Okay, already? Let's see. Cams. So I want to share the code. So this is the code. So 153, 165. Thank you, and if you are done, you may buy. So you may buy. If you are done, you may leave. Yeah, I was reading the comments. Yeah, bye. About the correct answer, the correct answer later next week you will be working on questions like this in the tutorial classes, right? And you will learn how to do it. Okay, bye-bye. Bye-bye. Be fun. Okay, first Google it. If you couldn't find the answer, then ask your tutor for an explanation. The last video will be posted on Times. I will post it on Times in a few minutes. The last video I will post it on Times in a few minutes. Just make sure you can key in the attendance. Okay, so Okay, bye-bye. Yes, 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 yes. I'm reading your comments, yes. Thank you, Malik. Jeff James, good office.